So in this video, we want to continue the other issues that pertain to the International Accounting Standard 16, property, plant and equipment. So in our previous video, we have the introduction aspect. We also have how property, plant and equipment is supposed to be recognized and how it should be initially measured, and the other expenses that are subsequently expensed or expenditure that are subsequently incurred on PPE, on an item of PPE, and how those expenditure are supposed to be accounted for. In this video, we want to look at the subsequent measurement and other issues the standard talks about. So we will start from how an item of PPE is supposed to be subsequently measured. According to IAS 16, that is International Accounting Standard 16, an entity is supposed to choose from two available models. So the standard provides two models for which an entity is supposed to choose from any of the models in subsequently measuring an item of PPE. So this model, we have the first one to be the cost model. We have the revaluation model. So now focusing on the cost model. So we want to now do on the cost model. So like I established earlier on, when it comes to the cost model, we are saying that the entity is supposed to recognize or account for each item of PPE at the cost, which is the same as the carried amount as the cost, which is the same as the costs. Then we less any accumulated depreciation. We less any accumulated depreciation. And then we less any accumulated impairment loss. Any accumulated impairment loss, that is about what the carried amount of an asset. Now, so what then is the carried amount? We know what is cost already in our previous video. We know what is cost. So what is our carried amount? What is depreciation? And what is impairment for that matter? When it comes to the carried amount, we are basically saying that is the cost of an asset less than accumulated depreciation and less than what the impairment loss. That actually is what is the carried amount of an asset. Now, what is depreciation? What is depreciation? Is the systematic allocation of a depreciable amount over a useful life of an asset. So when we talk about depreciation, we are saying that it is a systematic allocation of what of a depreciable amount over the useful life of an asset. So here we have seen another keyword in there. We have seen what is useful life, and we have also seen what is what depreciable amount. Depreciable amount. Now, when we talk about useful life, we are basically saying that is the period over which an asset is expected to be available to be used by what? By the entity. So the period that we expect the asset to be available to be used by the entity, then we say that is what? That is the useful life of what? Of the asset. We are also saying that it's either the period over which the asset is what expected to be available to be used by the entity, or the unit of what production or similar products that is expected to be obtained from what? From the asset. So it's either the period is expected to be available, or we are also saying that what the unit of products we are expected to what obtain from what? From that asset or from that item of PPE. That is basically what the useful life. So then, when we talk about what depreciable amounts, we are basically looking at what the cost or the amount of what substituted for the cost of an asset after taking into consideration residual value. So after we've less what residual value, lessen what residual value, that is about what depreciable amount. We are saying that is the cost or amount which is what substituted for what for cost after lessening what residual value. Basically, when we talk about depreciable amount, we are looking at what the amount that is attributed to what to the depreciation. Because when you look at the definition of depreciation, we are saying that the systematic allocation of what the depreciable amount over the useful life of what? Of the asset. So here to the useful life, basically sometimes we buy or we construct certain assets and we say that it will be in the business for maybe these years, or we are expected to obtain this amount of units from it, and from which we will dispose it of, or from which its economic benefit will all be what? Enjoyed. So sometimes we buy vehicle and then we say that the vehicle will last for maybe 50 years. These are estimation that mostly the management of an entity will carry out. So we've also seen another keyword over here. So if you want to have an example under the depreciable amount, basically let's say the cost of an asset is $100,000, and then we are saying that the residual value is maybe 40,000. Then in this case, the depreciable amount in this case, so the depreciable amount in this case is going to be what? The cost of the asset minus what? The residual value, which is going to give us 100,000 minus 40,000, and this will give us $60,000. So this is what we are going to what? Share over the useful life of the what? Of the asset, since it's a systematic allocation. So this is what we are basically going to allocate, because this becomes what? Our depreciable amount. Now another keyword that surfaces over here, that is what? The residual value. The residual value. When we talk about the residual value, we are saying that is the amount that is what? Currently expected from what? From the disposal of an asset, after taking into consideration or after lessening the cost of what? Disposal. So when you have an asset that amount that is estimated that you what currently obtained from the disposal of what? Of the asset, after taking into consideration the cost of the disposal, then we are looking at what? Residual value. So these are some few terms that comes with what? The cost model and that and depreciation for that matter. Now, the standard prescribe, or we have series of methods of depreciation, of which most accounting students are aware of, those that have done accounting at the basic level. So we have series of what? Depreciation method under the standard. So here we have what we call the straight line method, or the fixed installation method, and we also have the reducing balance method. We have also the unit of production method, or the machine hours method. We also have the sum of year digit, revaluation method, and the rest. Under the standard, most questions will use the straight line method or the reducing balance method. So that is what our focus is going to be placed on. So most questions will come using the straight line method or the reducing balance method under the depreciation. Now there are some few things you're also supposed to know under depreciation. When it comes to depreciation, we know the methods that you are supposed to use, or the method that the standard has prescribed. Either we are using the straight line method, or we are using the reducing balance method, depending on what the entity wants to use. But remember that once you have adapted a particular method, you have to subsequently use that, unless of course you have to change a policy. There is a need for change of policy, or there is a need of change in estimate, if any of them arises according to IAS 8. Then if that comes in, then you can change it. But once you have started with a particular method, then you are subsequently required that you use that method as well. So like I said, we have series of methods, but most questions will come using the straight line method or the reducing balance method. Now there are some few things you're supposed to know when it comes to depreciation. The first thing is that when should you start depreciation on an asset? Remember that you should start calculating, or you should start depreciating an asset when the asset is ready for use, or when the asset is available for use, not when the asset is being used. So you start depreciation when the asset is used. Here you have to focus, or you have to pay attention to years. Very, very important when it comes to year, as opposed to pay attention to years. Then when should you also stop depreciation? Remember that you can cease depreciation when the asset is being held as a non-current asset, held for sale, and discontinued operation, that is under IFRS 5. It's only when that asset is being held as such that you are supposed to stop depreciation. That means that if the asset becomes idle or it is not being used, it doesn't mean that you should cease or you should stop depreciation. You have to continue to depreciate the asset. It's only when the asset has been classified as a non-current asset held for sale, or when its economic benefit has been fully utilized or has been enjoyed, or when the asset has been disposed from the entity. That is when you are supposed to cease depreciation. Now, I'll be mentioning the straight line method. So what are we looking at under the straight line method? Here we are saying that it is the cost of the asset, then we less our residual value. Remember that the residual value is the same as salvage value, the same as your scrap value. The residual value is the same as your scrap value. Then you divide all these by your useful life, the useful life of the asset. Then when we are looking at the reducing balance method, here is the net book value. We charge depreciation on the net book value or the written down value. Okay, we charge depreciation on the net book value. That means that this place from here, the depreciation is the same for all the useful life of the asset, but here the depreciation decreases as you continue to use the asset under the reducing balance method. We've done this, or we know what this entails, so I don't want to go deeper into the methods of depreciation, but rather look at the key important things under the depreciation. One thing you are supposed to note is that anytime you are acquiring an asset and the asset has major component and each major component useful life can be determined, then that means that the asset are supposed to depreciated separately. Anytime an entity constructs or acquired an asset which has major components, and those major components have their respective useful life or can be separated from the major asset, then it means that that particular asset, the major component, are supposed to be depreciated separately, because their useful life for one particular component will be different from the other component. We can look at the question on the screen to establish an understanding about depreciation of a major component part. Alright, so on the question on the screen, we are told that Robert PLC bought a new Gulfstream jet for $5,500 million, and then the company has identified the following cost component asset and respective useful life. So we see here we have the engines, we have the fuselage, we have the airframes, we have the fittings, and these all have major component and their respective useful life. So when it comes to these kind of questions, you are supposed to depreciate the major component part separately. Although we know that the cost of the asset is $5,500 million, we cannot just depreciate this one because the major component has separate useful life. So we have the airframes, we have the engine. So for instance, if you are using the straight line method in this case, so what amount of depreciation will be accounted for in the books of Robert PLC? So you are supposed to do the depreciation for each, or calculate the depreciation for each of the major components. So here in this case, let's say we have the item over here. So let's say we have the item over here, and then we have the cost over here, and then we have the depreciation amount. So this is assuming we are using the straight line method over here. So in this case, the engine, which costs 2,000, so here it will be 2,000 divided by 3, so which will probably give us $666.67. And then we have the airframes, which is 1,500, having how many useful life? 10. So this is going to be 1,500 divided by 10 in this case. So let's look for the depreciation. So 1,500 divided by 10 is going to give us 150. And then we also have the fittings. In fact, fuselage before the fittings. So fuselage, which also costs 1,500 with the useful life of 20. So here the depreciation is going to be 20. So the 1,500 divided by 20 is going to give us $75. And then we have the last one, which is the fittings, and the cost is 500, and the useful life is what? 5 years. So in this case, our depreciation is going to be 500 divided by 5, and it's going to give us 100. So we sum all these up. So with 66.67 plus 150 plus 75 plus 100. So this is going to be 991.67. This is going to be our depreciation for the period. It's going to be our depreciation for the 3 years. So remember that anytime the asset comes with what? With a major component part. With a major component part of which we can separate their useful life separately, or we have depreciation percentage for each of them. In case you're in a reducing balance method, they can give you what? Depreciation percentage. Then you are supposed to what? Separately what? Depreciate them. Don't depreciate, although we know their total cost. Don't totally what? Depreciate them together. So that is it for issues under what? The major component what? Part. Now we want to continue with the issues under what? Under the depreciation, or the issues under the cost model. There are sometimes too that the assets useful life will need a review. So when that happens, how are you supposed to go about it? So sometimes we may acquire an asset that the useful life is what? 5 years when it was initially what? Acquired. But maybe after it has been used for 2 years, then we say that what? There is a review of the useful life. Sometimes it will increase, sometimes what? It will decrease. So when there's a review of the useful life of the asset, we are supposed to what? Have or understand how you are going to go about it. So sometimes an entity may acquire an asset, initially attribute its useful life to it, but maybe subsequently, after using it for what? For some time, maybe economic issues or maybe technological issues, that asset cannot have the useful life they have attributed it to have. Therefore, there is a need for what? For a review of the useful life. When that happens, you are supposed to take the review into what? Into consideration. Let's look at these two questions on the screen so that it will help us in understanding the review of the useful life. So we saw that an asset was purchased for $100,000. For $100,000 on the screen, and then on the 1st of January 2020, this when the asset was acquired, and then it's supposed to be depreciated at $1 of 20,000. That is a straight line method because it has no residual value. And the annual review of the asset, this one, they said the annual review of the asset lives is undertaken, and for this particular asset, the remaining useful life as at 1st January 2022. So the remaining useful life as at 1st January 2022. So they've reviewed it and they have said that for 1st January 2022 is 8 years. So what will be the depreciation in 31st December 2022? That is the question on the screen. So initially they acquired the asset on 1st January 2020, and this is the depreciation for each year. So probably it's going to be lasting for 5 years, because if you divide the year by this one by 5, you get it what? The 20,000. So if that happens, how are you going to account for this review of what? The useful life? It's very simple. Now let's, at the date of the review, what is the carrying amount of the asset? At the date of the review, what is the carrying amount of the asset? Remember that when we talk about carrying amount, we are saying that is the cost, we less our accumulated what? Depreciation, and then we less our accumulated impairment, if there is any. Impairment is also having accounted for under IAS 36. That's why I didn't talk much about it. So it's having a separate accounting standard. That's why I didn't talk much about it. So when you come there, we will probably look at it. It is when there's a differences between what? The carried amount of an asset and the recoverable amount of what? Of the assets. So if the carried amount is greater than what? The recoverable amount, then we say what? The asset is what? Has been impaired. Now, so with the review of this, now you have to determine the carried amount as at the date of what? The review. So from here to the end of 2020 is 1 year, and then 2021 is another 1 year. So that is what? 2 years. 2 years. Now, when we talk about accumulated depreciation, we are basically looking at what the summation of what all the years what depreciation together gives us the accumulated what depreciation. So in this case, our carried amount as at 31st December 2021, which is become the opening in 2022 1st January, is going to be the cost, which is 100,000 minus what 2 is, because we have used the asset for 2 years, multiplied by the depreciation, which will give us 40,000. So in this case, we are going to get what 60,000 as the carried amount. So here the question is asking us for the depreciation that will be charged in the books of the entity at the end of December 2022. Now the useful life as at this date as well has changed from the 5 years to, they said, 6 years. They said the remaining useful life. They didn't say the useful life is now, they said the remaining. The question is specific, the remaining. If they should have said that the remaining useful life, if they should have stated that the useful life of the asset is now maybe 8 years, then we would have taken the 2 years that we have already used the asset from it before we will use the rest. But here they said the remaining, they have given us the remaining, so it's 8 years. So we divide this one by what? By 8 to get our what? Our annual depreciation. And when you do this correctly, you are going to get 7,500 to be our annual what? Depreciation in this case. So the depreciation at 31st December 2022 is going to be what? 7,500. That is the review of what? The useful life. So let's look at the next question under the review, which will also help us to understand the concept very well. What I was talking about earlier. They said a machine was purchased 3 years ago on 1st January year 2. It cost 150 and is expected to last for 10 years with an expected residual value of what? 30,000. Due to technological changes, the expected life of the asset was reassessed during the year 5. So during year 5, the expected asset was what? Was reviewed. So he said the machine was purchased 3 years ago. 3 years ago. That means they have used the asset 3 years ago on 1st January year 2. And it will cost them, so the cost of the asset is 150. And we have a residual value there to be $30,000. Then initially they said the useful life of the asset is what? It's supposed to be what? 10 years. Supposed to be 10 years. And they said due to technological changes, the estimated useful life of the asset was reassessed during year 5. So that means they have used the asset up to year 5, and then the total useful life is now what? Expected to be 7 years. Now they have, after the review, they now said that this one will not be a 10 years again. Now the expected useful life is going to be what? Right. So if you look at the questioning properly, you are supposed to what? Take the years into consideration, because they said they acquired the asset on 1st January in what? In year 2. That means they have used the asset in year 2, they have used it in year 3, they have used it in year 4. But in year 5, they have what? They have reviewed the useful life. So the depreciation in year 5 will not be the same. So they said what is the depreciation charge for the year ended 31st December year 5 will not be the same as what? When you have acquired the asset. So this is how you are supposed to go about this. What will be our annual depreciation when we initially acquire the asset is going to be the cost of 150 less our salvage or residual value of 30. Then we divide it by what? By 10. So if you do this properly, you are going to get $12,000 to be our annual depreciation. Now we have to determine the carried amount after the day that the review is what is being taken care of. And remember that we have used the asset for 3 years to the review date. So here the carried amount is going to be the cost, which is the 150,000 minus our accumulated depreciation. So 3 multiplied by what? 12. So this is going to be $36,114,000. So the carried amount of the asset as at the date of what? The review is now what? 114,000. Now they said the useful life of the asset is in the year 5 is now 7 years. Now this means that they have already used 3 years here. So in year 5, of which our depreciation, we want to know the carrying amount. We want to know the depreciation in year 5 is going to be what? The 114 divided by what? 7 minus the year that we have what? We have already what? Used it. In the previous question, they said the remaining useful life. This one they are saying is they are telling us the total useful life that is available as at what? The year, the 5th year. Okay, so that is the difference over here. So here we have to less the year that we have already used the asset from the new what? Useful life. So here is going to be the 114 divided by what? The 4 years, because that is the remaining what? Useful life. In the previous question, they've already given us what? The remaining useful life. So in doing this, divided by 4 is going to give us $28,500. So it's going to be what? The 28,500 for the year 5. That is going to be the depreciation that's going to be charged in year 5. So that is it for also review of what? The useful life of what? Of an asset. The next thing we want to look at under the cost model is major inspection. Major inspection. There are some times that an item of PPE cannot work properly until it has been what? It has been inspected. And a typical example is what? Is an aircraft. When an aircraft lands at a particular airport, it needs to be what? Inspected. There needs to be what? Inspection carried out before the aircraft would take off. Anytime an aircraft or an item of PPE has been what? Has been carried out a major inspection on it, then that major inspection is supposed to be what? Treated separately, because it will have separate, useful life. So when there's a major inspection, you are supposed to what? Know how to what? Treat or account for each treatment. You are supposed to depreciate it from the cost of the asset, and then what? Know how to account for what? Each carried amount. Without wasting my time, let's look at the question on the screen about what? Major inspection and how we can go about it. They said an entity purchased an aircraft that has expected it to be what? To last for useful life of 20 years with no residual value. So the aircraft requires substantial overhaul at the end of 5 years, 5 year, 10 year, and what? 15 year. So this is what it means. They've acquired what? An aircraft, and this aircraft has 20 useful life, 20 years useful life, and then this aircraft will need to be what? Will need to be inspected at the end of what? Year 5, at the end of year 10, and at the end of what? Year 15. We've been given that information, and then they said the aircraft cost. So the cost of the aircraft is 25 million, and then dollars for that matter. And then 5 million of this figure is expected to be attributable to the economic benefit that are restored by what? The overall. So they said 5 million of this will be what? Will be the major inspection or the overhaul that will be installed. So in year 6, the cost of the overhaul is estimated to be 6 years. So in year 6, in the 6th year, it is estimated that this will be what? The overhaul or the major inspection was. Calculate the annual depreciation for the year 1 to year 5, and then year 6 to year what? Year 10. So in this case, we want to know the depreciation that will be attributed to the asset from year 1 to year 5, and then from year 6 to what? Year 10. And this is how you are supposed to go about it. So first, because of this major inspection, which have what? Different useful life, we cannot use the 20 years for the 5 for the major inspection years, because they said it's supposed to be what? Overhaul is supposed to be major inspection is supposed to be carried out after what? After every 5 years. So when it happens like this, you cannot use this one. You cannot use the 20 years of the useful life for the 5 years, for the 5 million, or the major component what? The major inspection what component. So in this case, the cost of the asset is now going to be what? The 20 million. We are supposed to what? We will take the 5 million from this, which will be the 20 million, divided by what? Divided by 10, and this will give us 2 million. So 2 million will be the annual depreciation for the cost of the asset. That is going to be the 2 million. Now we are supposed to what? Also depreciate this one separately for the first 5 years. For the first 5 years. So for the major overhaul or the major inspection is going to be what? 5 million divided by what? 5. And this is going to give us what? is going to give us 1 million. So in this case, we are going to have our depreciation for the year 1 to year 5 to what 3 million, because it's a straight line method. So year 1 to year 5 is going to be what 3 million. Now when you go to year 6, the cost will still remain this one, but when it comes here, it's going to be we are now going to change what when it comes to 6 to 10, and then the overall inspection is going to change. The depreciation is going to change over here, because they said now the value of the overall, or the value of the inspection is now what is now 6 million. So in this case, it's going to be the 6 divided by what 5, which will give us 1.2 over here. So from year 6 to year 10, our depreciation is going to be what 3.2 million. So please, when you are giving this major inspection, you are supposed to what? You are supposed to separately, depreciate them. You don't depreciate them together, because the major inspections or the overhaul, if it's not carried out, the item of PPE will not be allowed to take off. So I think the useful life of the asset is supposed to be 20 years. So here it's supposed to be 1, and this place is supposed to be 1. Aside that, everything will be done. So here it will be 2 million, while this place it will be 2.2. So I think that's the only difference here. So the useful life of the asset was 20 years, but I used 10 over here. So I've changed it to 20 years. So that means you have for the main asset 1 million. 20 divided by 20 will give you 1, and 1 for this one as well. Alright, so let's look at another important thing under the depreciation. Okay, like I established in our previous lesson, that there are some times that you'll be required to exchange a new asset for an old one that is being used by the entity. So when that happens, what amount should be accounted for to be the new carried amount of the new asset that is acquired. So let's say we have an entity here, let's say EPLC, and it's having an old vehicle, and want to exchange it for a new vehicle. This one costs is dollars of 10,000, and then this one, the carried amount after the day that they want to exchange, is costing us a dollar of 1,000. Maybe this one is giving a discount of $1,000 as well, a discount of 1,000. When it comes to what amount should you attribute to the new vehicle? Is it going to be the 10,000? Please, is no. We are going to use what we call trade in allowance value, the value of the trade in allowance. And how do you get that? After you have less the discount given, you get $9,000, and then you also less the carried amount of the asset from the cost, which will give us after less than the 1,000, it will give us 8,000. This value here is what we call the trade in allowance. It's like you are going to do swapping of an item. Assuming you are using phone for that matter, when you are taking the phone, you pay some amount of for the phone. That amount that you have paid will probably be the carried amount of the phone. So you take it from the cost of the phone, and then if the seller or the producer is going to give you a discount, you take it. So the total value is now going to give you your trade in allowance. So here, remember that it's the trade in allowance. That is the cost that we are supposed to carry or use in the financial statement of the entity. So let's look at the question. It says subscribe PLC Motors vehicle village fleet was replaced during the year, and the fleet originally cost. So the fleet originally cost 42 million and had been written down to 11 million at the time of the replacement, and the gross cost of the fleet replacement was 180 million, and the trading allowance of 40 million was given for the old vehicle. What amount should be included as the cost replaced? So here you don't have to do any calculation. You straightly go for the 14 million, which is the trading in allowance. So remember that if you are exchanging an old asset for a new one, then take into consideration the carried amount of the old one, take into consideration the discount that will be given, and then the cost of the new one. After you've lessened all of them, what you have gotten becomes your trade in allowance, and that becomes the cost of the asset. So I think the next thing we can talk about under depreciation is about the issue of land. Land has an indefinite useful life. So for that matter, we don't depreciate land, or we only adjust it for impairment or test impairment on land. But sometimes, questions will be given like land and building is costing 10,000. In such situation, you always be given the component of the land and the component of the building, because land is having an indefinite useful life. For that matter, it's not supposed to be depreciated. So mostly you'll be given the separate values for the land and the separate values for the building. So that is it for land and building as well. So basically, we are done with the cost model. Remember that with the cost model, an entity is required to recognize its or subsequently measure its asset at the carried amount of the asset, or the cost less accumulated depreciation less accumulated impairment loss. In case there is impairment, the question will probably give it to you. But since there is an international accounting standard on impairment, we will not talk about it over here. So we want to look at the next model, which is the revaluation model. So we now want to focus our attention on the revaluation model and look at what goes into that one too. So we are looking at the revaluation model. Remember that the entity can either use the revaluation model or use the cost model, depending on that suits the entity. We are not the entities or firms are not obliged to adapt or choose just one or choose a specific one. They are left with that choice to choose which of the model that they think will be appropriate or will enhance useful information for end users to be used. So in this case, when we talk about the revaluation model, we are saying that we want the fair value of the asset, the fair value of the asset at the date of the revaluation, after taking into consideration subsequent depreciation and subsequent impairment. That is basically about revalue. Okay, so here, after initial measurement, we are not going to depreciate the asset, but rather we will hold it for revaluation. So that will be the fair value at the date of the revaluation. That is what it means. So there are sometimes you have upward revaluation, and there are sometimes you have downward revaluation. What do we mean? Let's say the cost of the asset is $10,000, and then maybe after 1 year of the use, now the asset has been revalued to 11,000. So this one will be upward revaluation. And then sometimes too, there will be downward revaluation. Let's say the asset cost the 8,000, cost the 10,000, but it has been subsequently revalued to $8,000. So here there is a downward revaluation. Now, anytime the asset is going to be subsequently revalued, then before you can check whether there is a revaluation loss or revaluation surplus, here when it is upward revalued, you get what we call revaluation surplus, and when it is downward revalued, you get what we call revaluation loss. You have to compare. Always remember, you don't compare the cost of the asset with the revalue figure, but you compare the carrying amount of the asset with the revalued figure or revalued amount. So maybe you have, sometimes they can acquire the asset and use it for 5 years, and at the end of the 5th year before they revalue the asset. So remember that you have to first look for the carried amount of which is the cost less any accumulated depreciation, less any accumulated impairment. Then you compare that carried amount with the revalued amount before you can say whether there's an upward revaluation or there's a downward revaluation. So when there's an upward, it's going to lead us to revaluation gain, and when there's a downward, it's going to lead us to revaluation loss. That is it for revaluation model. Now let's look at these critical things over here. Let's look at the presentation of this revaluation issue. Let's look at it critically over here. So first, let's look at when it is upward revalued. When it is upward revalued. When an asset is upward revalued, that means that particular asset is having revaluation gain. Revaluation gain. And revaluation gain are always treated in the OCI. And we send the revaluation gain to the other comprehensive income. That is, if you don't have any opening balance of what? Revaluation gain or revaluation loss. So please remember that with the upward revaluation, which will give rise to what we call revaluation surplus. So revaluation surplus is always treated or taken toward other comprehensive income. That is with the upward revaluation. Now let's come to downward revaluation. This will lead us towards revaluation loss. Revaluation loss. Revaluation loss is always taken to our profit or loss account or the income statement. So please take note. When there's a downward revaluation, which leads towards revaluation loss, is going to be taken towards to your P&L account, and if the revaluation surplus is going to take into what? Your OCI. But let's look at these exceptions over here. If the asset has an opening, that is previously they have revalued the asset and there was what? They have a revaluation gain in the OCI. Then if there's a revaluation loss, we have to what? Go and expense. We have to go and adjust that revaluation loss with the opening revaluation gain in the OCI. If there is still a remaining revaluation loss before we will take it to what? To the P&L account. What am I saying? Assuming that we have compared our carried amount of an asset with what? With the revalued amount, and this is giving us a revaluation loss of what? Maybe $1,000. But already the question has informed me that there's a opening revaluation what? Opening revaluation gain. This one is revaluation surplus, revaluation gain in the books of what? $600 in the OCI. So this one is in OCI. Then if you want to send the revaluation loss to your P&L, you can only send how much? 400 because that particular asset already has what? Revaluation gain in the books, an opening one. So you have to take it, adjust it with this one before the remaining one will go. In the case where the gain is sufficient to cater for all the loss, then nothing goes to the P&L account as a revaluation loss. So here, if the opening balance is 1,500, that's the revaluation gain. Opening balance is 1,500, and you are incurring a loss of 1,000. Then nothing goes to the P&L account as a revaluation loss. Please let's take note of it because it's very important. So anytime there is an opening revaluation gain and you are incurring revaluation loss, you first have to attribute it. But remember that revaluation loss are always treated in the P&L account, and the revaluation surplus is always treated in the other comprehensive income. So without wasting my time, let's look at the question on the screen to augment our understanding of the revaluation concepts. So we were told that R or Being PLC purchased a plot of land on the first day of 2016 accounting period, and the business applied the IAS Revaluation Model to the measurement of the land after initial recognition. The business has a policy of revaluing the land annually, and the initial amount recognized in the year value are as follows. So initial measurement. So we were told that the asset initially cost $100. This is the initial measurement. So at the end of 31st December 2016, so at the end of the year one. So here, let's have our P&L over here, and let's have our OCI over here. Now, we have how many years? We have 2016, 2017, 2018, 2019, and then this, that is the last year in the question. So we have our $sign here. So this runs through the OCI as well. The same thing over 2016, 2017, 2018, and then 2019. We want to look at this revaluation gain and revaluation surplus. Now, at the end of year 1, 2016, we're told that the current asset, the value of the land has been revalued to $130. That is at the end of 2016. This is the beginning, initial 1st January. So this you can see that there's an upward because the closing is greater than the opening, or the carried amount at least is lesser than the opening. So there's a revaluation gain of how much? 30. The difference between this and this will give it the revaluation gain of 30. Here, because the revaluation gain, we don't send it to the P&L account. We send it to to the OCI. So here I will come in the name of revaluation gain or revaluation surplus, and the amount is what? $30. So now if you go to the statement of financial position, the land now will cost the 130 dollars if you go to the statement of financial position. So this becomes the opening in what? In 2017. Okay. So in 2017 we're told that the asset cost how much? 110. So in 2017 we're told that the asset now is revalued to 110. Remember the opening is what? 130. Now it's now revalued to what? 110. That means there is a revaluation loss because the revalued amount is less than what? The opening. So there is what? There is a loss of what? $20. Because between this and this is $20. There's a loss of $20. And remember that the loss is supposed to go to what? Our P&L account revaluation what? Loss of 20. But because there is an opening revaluation gain on that particular asset, we cannot send this one to what? To the P&L account. We have to go and expend all. In other words, this place was credited. We are supposed to go and what? Debit it so that it will cancel that amount in 2017. So in 2017, here we are not going to do anything over here. You come here and what? Debit in the OCI account revaluation surplus of what? Revaluation loss of what? 20, which will what? Cancel this one. The reason why all the 20 is coming here is because all the 20 can be calculated for by the what? The revaluation, the opening revaluation what? Gain. And assuming that this revaluation gain was maybe 10 over here, then we can only what? Debit this one with 10 and take the 10 of this one to what? To the POL so that we can have the 20. But in this case, all the revaluation gain all the revaluation loss can be catered for by what? The revaluation what? Gain. So here it will be in bracket 20 so that you can see the effect here. So remember that the opening revaluation gain now is what? Is left with what? It will be left with what? 10 in 2017, but we don't bring it over because we have already treated it over. It's a yearly something, so we just show this one revaluation what? Lost, which is against what? The revaluation gain over here. Let's go to 2018. In 2018, now we are told that the assets now cost 95. So this means a further what? Revaluation loss of how much? Between this and this is going to give us $15. So there is a further revaluation loss of $15. Remember that we are left with what? 10 revaluation gain, opening revaluation gain over here. 10. So here I can bring all the 10 over here. This is 15, but I don't have 15 here. So that the rest of the revaluation loss will go towards my P&L account as 5. So if I add this and this, I will get the 15 revaluation what? Loss. Please, this is how we go about what? The treatment. Now I'm doing this because the question is what? Is the same. We have respective what? Years. But assuming that in your case is just 1 year, then this one you wouldn't have had this challenge. But because this question is having a series of years, that's how we go about it in this form. But assuming that in your case you have a question which is just maybe they just give you the opening figure and they just require that you do take the first word revaluation, then in that case we won't take the 2016 words into consideration. In fact, maybe the 2017 as well. We wouldn't have been doing this over here because we wouldn't have had previous knowledge about what has happened. But this one we are starting from the beginning, and what we are subsequently looking at what will happen. So please remember this one is left with 10 over here. So we take all the 10. Now we can see that this and this has taken the 30 away, and then the rest must go towards your P&L account because it's a revaluation what? Loss. So always revaluation loss goes to the P&L account, and the revaluation gain comes to your other comprehensive income. Now let's look at what happened in 2019. In 2019, we were told that the cost of the asset or the revalued amount of the asset is now 116. This, if you compare this one, the 95 with the 116, that means there is a revaluation what? Gain of what? $21. Again, because of the nature of our question, you cannot take all the 21 to what? To this account. You are supposed to take only what? Only $16 because you will take the 5 from it before you send it here. It is because of the nature of our question, because of we have subsequent what? Yes. But in your case, in the case where you are given just 1 year, you will just be told that there is what? Opening revaluation loss of or opening revaluation gain, then you are just supposed to what? Adjust your subsequent what? Revaluation surplus or revaluation gain with what? The opening you have been what? Given. But here we have privy. We are privy to what? The opening revaluation loss in this account to be 5, and we are making a revaluation gain of 21. So you are supposed to what? Take it from this one first before what we treat the rest as what? Revaluation gain. So please, this is about the issues of what? Revaluation method. So remember that upward revaluation, we treat it in what? That will give rise to revaluation gain. So we send it to what? Our OCI. And downward revaluation, which is revaluation loss, we treat it what? In the POL account. But in a case where we have an opening revaluation gain and there's a revaluation loss subsequently, you first have to adjust it on the opening one before, if there's any additional one or left over, before we send it to what? The POL account. So we have also used this question to augment our what? Understanding with the issues of what? Upward and downward revaluation. So gradually we are drawing a curtain to a close on the International Accounting Standard 16. So I think the last thing we are supposed to look out for is what? Disposal. How to account for disposal in case it falls due. Disposal. So there are sometimes the item of PPE will be disposed of from the books of the account, and you'll be required to what? Determine whether what there is a disposal gain or there is a disposal what? Loss. We have two ways of doing this. I'll show you all the two methods of accounting for a disposal gain or a disposal loss. The first one is using the ledger, the T account. So when we come to the ledger, let's use the question on the screen to establish our understanding on this one. They said a non-current asset costing. So the cost is originally cost 75,000 and has an accumulated. That means they have used it as at the day that they are disposing of, or to be the depreciation. So the accumulated depreciation at the day they are disposing it of is what? Is $51,000. And then we were told the asset was sold off. So the asset was sold off. So that will be the proceed from disposal. We call it proceed from disposal or disposal cost. Proceed from disposal is $18 on the screen. And then before they can make this sale, they made a cost on disposal of $500. They made a cost on disposal of $500. Now, if you are using the tin account, so this will be disposal account. So we will close the account, the asset account for the cost. So if you are closing it, probably you know that this one is having a debit balance. So if you are closing it, we will credit the asset account and come and debit the disposal account in the name of what? The asset, which is what? The 75,000. And also remember that provision for depreciation always have credit balance. So if you are closing it, you will debit the provision for depreciation account and what? Come and credit what? This account with accumulated what? Depreciation. Accumulated depreciation of 51,000. And then when it comes to this one, we will less the cost, we will less it from this one to get the proceed. Is okay. So remember this one, when we are receiving cash, so we debit cash and we credit what? Disposal account in the name of what? Proceed from disposal. It can also be in cash here, cash from disposal. So here is going to be what? 17,500. So in a time, we will always have the gain over here, and we also have a loss over here. Okay. So if this place is what? Is lesser than this place, that means this place will be bigger than what? Than this place. That means what? There's a gain over here. But if this place is also bigger than this place, then that means what? There is what? There's a loss over here. 17,500 is going to give us 68,500. So that I think there's a loss in this case. There's a loss in this case because this place is lesser than what? This place. So we have to, that is going to give us 6,500. 6,500 loss, because if you add this and this, we can get the 75,000. So there's a loss of what? 75,000. Another way we can also treat this cost on disposal is that we can bring all the 18,000 over here and then have cost on disposal over here to be the 500. So this is the first method. This is when we are using the T account. Remember that always at the credit side, when the difference is coming at the credit side, it will be lost. When the difference is coming at the debit side, it will be going to be what? It's going to be a gain. So now let's look at other method we can use to account for a gain or loss on disposal. So remember that in the previously we used the T account. When the difference is coming at the credit side, then there's a loss. If it's coming at the debit side, then there's what again. Let's see if you will get the same loss over here. So this one, let's have our two beside. We are using dollars, not CD, so we are using dollars over here. So first, proceed from what? Proceed from disposal. Proceed from disposal. So the proceed from disposal is 18,000, and then we less costs on disposal. Cost on disposal is 500 here, so we are going to get 17,500. That is going to be the net proceed from disposal after lessing the cost. Then we have the cost of assets. The cost of assets is what? 75,000, and then we less accumulated depreciation. Accumulated depreciation in this case is 51,000. So if you less 51,000 from here, it's 5025. So you're going to get 24,000 as our carried amount of the asset. So let's take. So this is going to give us 66,500, which is in bracket. So this is bigger than this. So this is going to be what? Loss on what? Disposal. Loss on disposal. So these are two forms. So you see that we have gotten the same 6,500 that we had in the T account. So these are two ways that we can account for what? Gain or loss on disposal. So assuming this place was bigger than here, then it would have been what? It would have been a gain. Remember that after revaluation, we can subsequently what? Depreciate the revalued figure, depending on what you have in the question. So on a revaluation, after you have revalued the figure, an information can be given to you as to how you should subsequently what? Depreciate that revalued amount. It's either we use the reducing balance method or use the straight line method, using the same approaches we use in the depreciation method. So remember that after revalued, or after we have carried out revaluation, we can subsequently measure the asset. Then the next thing is disclosure requirement. And in fact, impairment before disclosure requirement, but because impairment is having a new standard, we will look at it subsequently. So the disclosure requirement are supposed to disclosed the important things you are doing, how you initially measure your item of PPE, the cost that you take into consideration, the capital cost that you capitalized. You will also tell us whether you are going to use the cost model or the revaluation model. You tell us if the asset has a major component. All the things that we have looked at, you disclose them to the note of the financial statement. It will help in providing the adequate, useful information for end users to use for their decision purposes. So that is basically for the International Accounting Standard IAS 16. But if you have any question, you can leave it at the comment sections and it will be attended to, and probably you will solve more questions subsequently to augment our understanding on all that you have done. Thank you.